The measurement of a business combination is determined by the value of what was given up and not by what was received. The value of what is given up in a business combination is referred to as the consideration. Let's take a step back and consider where consideration fits in so you can contextualize the theory. IFRS 3 requires the acquisition method to be applied to all business combinations. The acquisition method consists of 4 steps. The 4th step is the calculation and recognition of goodwill or bargain purchase. It is in this step that consideration becomes important. IFRS 3, paragraph 32, sets out the formula for the calculation of goodwill, which is purchase consideration plus the fair value of previously held equity interest in the acquiree plus the amount of non-controlling interest minus the fair value of identifiable net assets of the acquiree. Therefore, in order to calculate goodwill, we first need to determine purchase consideration. IFRS 3, paragraph 37, provides the formula for the calculation of consideration, which is fair value of assets transferred, liabilities incurred, and equity interest issued by the acquirer. It is important to note that fair value at the acquisition date must be used for all components used in the calculation of consideration. For example, Alfred Stores is a large chain of supermarket stores. Its only competitor in a local town is Basa's, which is owned by Ismail Basa. On the 30th of June, Alfred Stores made a proposal to purchase Basa's business. The proposal included a cash amount of $300,000, a 1% shareholding in Alfred Stores with a fair value of $50,000, and a selection of premium wine which had a cost price of $10,000. Ismail accepted the proposal, and on the 1st of August the acquisition took place. On this date, there were no changes to the cash component. The fair value of 1% shareholding in Alfred Stores was $46,000, and the premium wine had a fair value of $11,000. In terms of IFRS 3, what is the purchase consideration for this business combination? To calculate the consideration, we would need to substitute the at acquisition fair values for each component. $311,000 is the at acquisition fair value of assets transferred, which is $300,000 cash component plus $11,000 fair value of the premium wine. No liabilities were incurred, so this is zero. $46,000 is the at acquisition fair value of the equity interest issued to Ismail. $357,000 is the purchase consideration for this business combination. IFRS 3, paragraph 53 provides a general rule and exception relating to acquisitions-related costs. Acquisition-related costs are not included in the calculation of the consideration. The exception to this rule relates to costs to issue debt or securities which are required to be recognized in accordance with IAS 32 and IFRS 9. Let's assume Alfred Stores incurred legal fees of $2,000 to draw up the purchase contract for the business combination and spent $3,000 on consulting fees to determine the value of Basa's and the optimal purchase price. In terms of IFRS 3, paragraph 53, both these costs are considered acquisition-related costs and are not included in the purchase consideration. Rather, they are expensed in the period that they were incurred. To recap, the purchase consideration is required to be calculated for the purposes of calculating goodwill. There are rules relating to how purchase consideration is to be calculated, and it is important to know what is to be included and at what value.